forex.net, and we continue our series of videos following the articles on the Trading Academy. Not only technical videos, but as you're about to find out later, some fundamental ones as well. This one refers to the most relevant trend indicators to use in the forex market, and the principles and indicators here are valid on anything that moves, if you want, on any chart or trading platform, regardless if it's the currency market or else. As always, everything we discuss here exists in the article dedicated to this topic, but the aim is to reinforce a bit what's discussed there and to put a bit of a visualizing effect on each pattern. This is the parabolic SAR, and the acronym stands for parabolic stop and reverse. This is nothing but a series of points that appear either above the candlesticks or below the candlesticks, showing a bullish or a bearish trend. The main problem with the parabolic SAR is that even during a bearish trend like this one here on the Euro and Japanese yen, the daily chart, so even after such a strong trend, it still has the power to put bullish or opposite dots, signaling the reverse of such a trend, so offering conflicting signals. The way to avoid this is to focus not on the price, but to focus on where the indicator plots the dots when compared with the last dot. For instance, here the market was in a bullish series because the dots were below the candlesticks, and then all of a sudden the parabolic SAR reverses course and is able to plot a new dot below the last one of the previous bullish series. This is a bearish entry and we should go short. And then the market continues and all of a sudden it puts a bullish dot, but this bullish dot here, or on this trend here, is not strong enough to put a dot above this one, so the bearish trend, the main trend, remains. And when the indicator is able to put another dovish or bearish dot, this is the place to add on the short side. And the same thing happens here and here and even here, all the way to here. All of a sudden at the bottom of the bearish trend, we see that the market rallies, the parabolic SAR reverses, and then manages to close above the last dot of this bearish section. This is nothing but a bullish signal, and we should close all the trades here and repeat the thing moving on the right side, on the long side. Another trend indicator, a very special one, is the Ichimoku Kinko here, the Ichimoku or the cloud. We will have a separate article on how to trade with the Ichimoku. At this point in time, just to note that this one has 5 elements. One, this is the Chinko. The red one, it's called Tenkan. The blue line, it's Kinjun. The cloud here is this shape, either bullish or bearish, and is being given by two averages, if you want. They are not quite moving averages, but two averages. They are called Senko A and Senko B. When Senko A is below Senko B, the cloud is bearish. When Senko A is above Senko B, the cloud is bullish. Now it may not tell much here, but if you go at the current price, you will see that the indicator or the Ichimoku projects the current price, projects the cloud 26 periods on the right side when compared with the current price, and the Chinko is 26 periods on the left side. This is called equilibrium at a glance, according to the Japanese traders, and it is one of the most important technical analysis principles out of Japan. It has the indicator has both a trending component, a support and resistance component, and an oscillators component, more later in this academy. Another trend indicator is the ADX or the ADMX. This is called the average directional movement index or average directional index. The indicator is this line here, the green line that you see here, and the other lines, the signal lines, the blue one and the red one, these are called the signal lines. These are plus DE and minus DE. Plus DE, these are directional indicators. And when you have a bullish cross like this one, when the red line moves above the blue line and the other X stays above 20, showing incipient trending condition and rising, the thing to do is to go on the long side and remain on the long side until it reaches the 40 level. Now with the other X, the more it rises, levels above 40 means a very strong trend. Levels about 70 means an exceptionally strong trend, but such trends do not quite appear on the currency market. This is the Dow Jones Industrial on the hourly chart. Look what a strong trend from 27k to 28k, and the ADX was barely able to exceed the 40. Therefore, trade the crosses while the ADX is above 20 to catch the move from 20 to 40, either to the upside or, in this case, still to the upside, or to the downside if you decide to trade a move to the downside as well for a bearish market. But even when you have a bearish trend, the ADX will also move to the upside. It just shows a strong trend regardless of the direction. Another trend indicator is the alligator, and the alligator belongs to Bill Williams indicators. If you go on the MetaTrader and check on the insert Bill Williams indicators and then Bill Williams, you will see that there are a lot of indicators that Williams developed, and one of them, or the single one of this that is the trend indicator, is the alligator. See here, it has a funny name, and these lines here are have a funny name as well, in the sense that one is the lips, this one, the fastest moving average, is the lips, and the jaws, and it means that the further the price moves into these averages, in this case the short trader, the bearish trader, will be eaten by the alligator, and so on. The idea to trade, or the idea to use when trading with the alligator, is to wait for all of them, to all these moving averages to align from the slowest to the fastest one. See here, when the red line moves below the blue line, then the blue line is on top of the red one, the red line is on top of the black one, and that's the entry place. But the key here to remember on the alligator is that it is shifted, the lines are shifted on the right side of the chart, various periods. For instance, from the current price, the blue line shifted 8 periods, this one is 5 periods, this one is 3 periods. It means that the actual entry, if we consider the red line, we must go back 5 periods from that, and there is the entry place. So at the end of these candlesticks, this is where we go short, not here, but here. And the same thing happened forward. One thing it's important to mention here, something important for any trend indicator, the ability of price to make, in this case, the slowest moving average to go one time, 2 times into or beyond the average moving average signals faltering conditions for the bearish trend and growing conditions for a reversal. And of course it reversed here. 1 time, 2 times, exit, it shows weakness on trending market, and then the market corrected. Another indicator to use is actually an oscillator, is considered an oscillator, but the histogram here of the OSMA, the histogram here is nothing but a representation of some moving averages. If you plot the moving averages here on the chart, you will find them. The idea here is to use oscillators when there is a transition from negative to positive territory. So when the market goes from negative to positive, here is a very nice entry on the long side. And then by the time that the the histogram bars are reversing, they start to reverse, then you simply exit. So just catch this kind of a move. Or here, by the time that the market moves all the way to here, just catch this move, and that should be okay for a temporary trending condition. Now it may not be much on the hourly chart, but if you do that on the daily chart, and with the vast number of currency pairs and markets that exist here, it would be enough to profit from the market. Last but not least, another oscillator that we can use as a trend indicator is the famous MACD, or moving average convergence divergence. The MACD plots a histogram as well, and the principle is the same. In the three examples here on the US dollar and Japanese yen daily chart, it proved to be quite rewarding. By the time that it moves below the zero level, we go on the short side. Stay on the short side all the way until the MACD is able to put longer and longer bars, and by the time that the bars are reversing, this is the exit place right here. So go short here all the way, something like this, exit here, the same thing here. This is a fake signal to see that you can go short here, but the market, instead of the MACD, instead of plotting new bars, growing bars, reverses and plots a positive bar. So it's very easy to reverse the trend and move on the long side, recovering the potential loss. Thank you for being here, and bye bye.